Very good afternoon and welcome to our webinar for today called How to Invest in 2016. Now, gentlemen, I just want to speed things up again. And just to reiterate, Roger just gave us a brief view on the theme of Great Southern yields and the Aussie falling dollar, which led us into Chris explaining, obviously, the move and change in terms of the middle class of China growing. Now, let's talk stocks, gentlemen. Roger, we'll start off with you. Can you just give me, you don't have to go in depth, just 3 stocks you think will capitalize on these themes for next year?
Sure. Well, a big one obviously is Challenger. It's benefiting from the aging baby boomers, and what we like about this particular company is that it's enjoying growth on growth on growth. Now, when you compound growth, you get exponential increases in the value of a business. So this business is benefiting by selling annuities to aging baby boomers or retiring baby boomers. Now, we've got more people retiring. We've got baby boomers getting older, obviously. Within that cohort, more people are moving from the accumulation phase of their superannuation to what we call the pension phase. So that's growth on growth, because annuities are about income in pension in retirement. And then within that pension cohort, currently annuities represent about 4% of portfolios. If that moves to 6% or 7% or 10%, then you'll get exponential growth in the value of the business. And what's interesting, in the Financial System Inquiry by David Murray, proposed mandating a percentage of superannuation portfolios being in annuities, and Challenger is obviously, going to benefit from that. And you can see the numbers for 2015 over on the right-hand side here. Assets under management in their fund business, now $60 billion, up 18%, normalised profit up 13%, full-year dividends up 15%. So this is a business that's going to enjoy growth for quite some time. I don't know what the share price is going to do. The question that's often asked of me, Roger, is in Skaffold, Challenger gets, I think, a C rating, and that's because it's got very high levels of debt. But when we look into that debt in more detail, what we find is the debt is matched by assets, and where the debt is matched by assets and it's financial debt and financial assets, then really we separate that debt out. If we take that debt out, we give Challenger a higher than C rating. So that's why we're interested in Challenger. And the other business that we really think is going to surprise people on the upside is realestate.com.au. And the reason why is, while we also think that property is peaking and it could actually have a correction next year or the year after, coming out of the overdevelopment of apartments, what we know is in the boom that we've just witnessed, people weren't all listing their properties on realestate.com.au. Houses were selling so quickly that they didn't even need to be listed. And when they're not listed, realestate.com.au doesn't get a fee. But the more properties that are listed and the longer they're listed for, the more money realestate.com.au makes. And so the REA group is going to benefit, because as there's more competition to sell properties because the market's not booming, then what we'll find is more customers will take out premier ads, which cost more, and they'll be on the realestate.com.au website for longer. And if they're on for longer, the company makes more money. That's precisely what we're seeing in their quarterly updates.
Okay, let's go global, Roger. Do you have any from outside the ASX?
Yeah, look, I think Apple is a company that's going to do very, very well, and I know it's a business everyone's heard of, and that's probably why it was available cheap, because they sort of thought ho hum. Really, what's happening though is that China is slowing down. More and more of Apple's growth is coming from China, and because China's slowing down, people think it's going to impact Apple adversely. But what they don't realise is that even though the Chinese economy is slowing, smartphone growth is at 5%, but Apple iPhone growth is 87% in China. So that's in an economy that's slowing down. So what an Apple iPhone is affordable luxury for the Chinese people, and so while they're cracking down on spending on Prada handbags and Rolls Royces and Bentleys, they're spending up on iPhones, and it's an affordable luxury item. And as 4G penetration in China is only 12% or 11% at the moment. So as 4G spreads, you'll find more people buying iPhones. And we also know that Apple has just launched a new program for iPhone owners where you pay $32 a month and you can upgrade to the newest iPhone at any time and keep spending $32 a month. Just hand your old iPhone in and you'll get a new iPhone. So that's going to increase the upgrade cycle. Only about 25% of iPhone users have upgraded to the iPhone 6. That'll increase the upgrade cycle or speed up the upgrade cycle, and it also gives Apple control of the old stock, which they can then destroy rather than see on the market, forcing more people to buy a new iPhone rather than a second-hand iPhone.
Wow, that's good. Chris, so what are your three stocks?
Sure, Shepard. So the ones I picked were initially Breville Group. So Breville Group is a consumer discretionary stock here in Australia. You know, they retail electrical appliances. And the reason I chose that one was simply that, both Roger and I have alluded to it, that the Australian economy is shifting away from the whole dependence on resource and construction, and shifting towards more being driven by the consumer. And the Australian economy has turned around a bit of late. It certainly hasn't shot the lights out or anything, but we have seen improving job numbers and some general positives in the Australian economy. Also, a company like Breville actually makes far more of its revenue from overseas than it makes from within Australia, and that's being assisted greatly by the low level of the Australian dollar at the moment. On education, Navitas. Navitas is a company that provides courses for foreign students, so particularly English language courses, and some courses for local students as well, but it derives the bulk of its revenue by helping students from foreign lands brush up on their English and prepare for university courses here in Australia. So that will obviously benefit from the trend where a considerable amount of not just Chinese but indeed Asian people are coming into sort of middle class and are able to therefore invest not just in the essentials of life but in things like education and the other one being travel. So inbound tourism, I chose AHD or Amalgamated Holdings. They're a company that have sort of two sides to their business. One is sort of the hotel side and the cinemas. So they're deriving a lot of their revenue from that inbound tourism sector.
All right, awesome. Now, gentlemen, for the last 5 minutes, I just wanted to ask all of our attendees to vote for one stock that you guys can just get into more detail and drill down into in terms of 2016. Which stock you would like Roger and Chris to quickly go through? REA Group Limited, Breville Group Limited, Navitas, Amalgamated, or Apple. So everyone has voted, and these are the results we've got. So we've got REA Group leading the charts with 25%, and very close is Navitas and Amalgamated. But we'll start off with you, Chris. Can you just give us a quick spill on REA, and then Roger will close off the webinar with that.
So let's just pull up REA and have a look at it. Now REA, as I'm sure many people would agree, is a very attractive business. You can see here, looking at the summary of REA in Skaffold, that it's a high quality business. It's an A2 business. Importantly, that middle bar, the historical change in value, very strong at almost 50%. So that tells you that over time this business has performed very well, and indeed it's forecast to continue performing very well. Now it's trading at pretty much what we would call fair value, or its intrinsic value at the moment. And if we just quickly go through the screens here, and Roger, feel free to jump in as we go along. We can sort of tic-tac on this.
Okay, no problem.
The earnings screen here is, you can see going right back, there's a very strong trajectory of earnings going up, and indeed into the future they're forecast to remain.
The only thing I will add is, the share price may not follow the earnings up. Our hope is that the share price actually reacts negatively to any correction in the property market, and that would present this company as cheap. And if that happens, we would be interested in buying more because we think it's going to surprise on the upside in terms of earnings and performance.
Yeah, well, I certainly hope you're right. Those of you who looked keenly at my SMSF would have noted that it was in there, and fortunately in there at about a 20% discount to what it's currently trading. So the capital history screen, again, we can see here strong equity. This blue line represents the return on equity, and that's sitting in the high 30s, close to 40%. And the red bars represent debt, and there is no debt. So very secure balance sheet and generating great returns on equity. If we go through the Skaffold score, consistently A1, dropped to A2 in this most recent period, but that's not really anything to be of great concern. And finally, looking at the value versus price chart, you can see, and as Roger has just alluded to, if it's trading at about fair value. If it was to dip due to a reaction to some, a negative perception around earnings, then that could indeed present a great opportunity to get into this stock at a lower price.
Thank you very much for joining us today. Thank you very much, Roger, and thank you very much, Chris.
It's a pleasure.
And see you guys next time.
Investing in shares can be rewarding when you do your research, but it can also take up a lot of your time. With so much information out there, how do you quickly sort through the companies worth investing in and those to steer clear of? Skaffold is my research tool of choice. It tracks and reports on all ASX listed companies, plus thousands of global stocks daily, helping me decide which stocks to buy and sell. I can quickly filter through the reports to get the information I need. The rating system is like a set of traffic lights for the stock market. Green is good, orange is caution, and red is don't go any further. Skaffold's top stock choices have been highlighted for their outstanding performance by Money Magazine. With Skaffold doing the work for me, I have the confidence to make investment decisions without having to spend hours sifting through financial data. Now you can take control of your time and your portfolio. Why not take Skaffold for a test drive today?